Good afternoon, everyone, and thank you for joining us for our panel. Today, we're going to talk about finding the best middle market growth equity managers. And we have a very esteemed group of panelists with us today, some heavy hitters. Brian Welker from Allianz Capital Partners, Christian Raby-Brondin from ATP Private Equity Partners, Andrew Kui from LGT Capital Partners, Edward Lemley from Swiss Re, and Holly Holtz, former director from TIAA-CREF. So we have 30 minutes to have a lively discussion, and we promise to hope to do that for you. And if you have any questions, we'd like to address those at the end. But today we're really talking about a group of panelists that have a very established private equity program, a stable team of managers in the middle market, covering both the lower, mid, and upper end of the ranges. So the question for today is, how does a manager who is managing capital in the middle market be considered by our panelists for investment? And so maybe, Brian, if we could start today, and perhaps have you talk a little bit about how you define the middle market and how, through our discussions, we've defined what does it mean middle market to each of the managers.
Okay. Sure. So for us, the middle market is basically everything that's not mega market. So you can begin by cutting it. Every fund $5 billion and above is not middle market, and then go down from there. You can segment it into upper middle market, pure middle market, or lower middle market. Really no set definition in terms of enterprise value or fund size that we apply. It's just kind of looking at the target investments and the types of companies that they are pursuing that we would use to group them into the middle market.
And Christian, you talked a little bit about fund sizes as one of the criteria for defining those groups.
Yeah, I think we tend to see the middle market as firms looking for companies up to 1 billion in enterprise value. But that said, it's kind of, there's no fixed definition as Brian mentioned. And I think what you see is also a lot of firms define themselves as mid-market groups. So you probably cover all the way from 100, 200 million in fund size up to perhaps 5 billion, as Brian mentioned. So by just saying mid-market, it's, I guess, basically most of the private equity market. Yeah.
Great. And Andrew, we had a little bit of a discussion ahead of time talking about generalists versus sector-specific managers, and maybe you'd like to comment on that a bit.
Sure. The way I think about it is, all things being equal, I'd rather have the best of both worlds, meaning generalists with multiple deep industry verticals within them. And the reason for that is that, you do get some of the advantages of people that have the right industry relationships and the ability to source for managers, source for deal flow, improve the operations. But you also get the diversification across the different industry sectors. I think one of the issues that I have with groups that have overly narrowly defined industry verticals is that, the saying about, to a man with a hammer, everything looks like a nail. And so that's what we're trying to avoid.
I just wanted to add to that I think that's an important part of building a core portfolio. But one thing we've also seen is that with certain industry sectors, energy, ones that are very complex, financial services, et cetera, it's often difficult to keep sort of the best, most specialized people within a more generalist firm. First of all, they find that when they're making investment decisions, investment committees, that members who don't have their expertise, it's a little bit harder for them to opine on those deals, and yet they are opining. So we've seen in certain sectors actually that there's been a burgeoning of specialization where it does make sense to invest. And generally those are also sectors that are broad enough so that you can find something to invest in regardless of what the part of the cycle you're in. So consumer products and services would be an example.
And Holly, what would some of the other sectors be that you mentioned?
Well, ones that we looked at specifically would be technology, as I said, consumer, certainly industrial, very broad, energy, financial services, particularly if it was pretty broad so that you know, weren't all in banking, for example. And we did look at, but never really did, a healthcare specific fund, but that also would make sense, particularly if it was pretty broad and was not, you know, too exposed to the regulatory side.
And Brian, I think you mentioned education as another subsector.
Yeah, we've looked at education, have not invested there, but I would say broadly, in the U.S. market in particular, we do like the specialist model. We're of the view that the U.S. is becoming more complex, not less so, and as we benchmark managers, comparing sector specialists to generalists, oftentimes the sector specialists will either have higher absolute returns or less volatility in their track record as well, and we believe that is a benefit of the sector specialization.
Yeah, perhaps just adding a little bit to that. I think we tend to do sector-focused funds. I'd say both on the very small end and also larger funds. And I think I agree with Andrew that it's great if you have a fund where you do have some different verticals, but I guess for a 200 or 300 million fund, it's also difficult to kind of have that multi kind of strategy. So we tend to do sector focused funds, but we also do more you know, broad focused funds as well if we see the right team and the right track record and so on.
And thank you. And Edward, you brought up a very good point during our discussion, and you talked about portfolio construction within your program at Swiss Re and talked about building a risk-return profile within the middle market. So maybe you could talk about that a little bit.
Yeah, thanks. I think the question for us is why are we looking at those smaller funds in the mid-market below what we heard, for example, $1 billion in fund size? And for us, it comes down to two key aspects. One is portfolio construction. The other one is, probably call it, refreshing the gene pool. In terms of portfolio construction, the way we look at our portfolio is that we first aim to build a stable base of oftentimes long-term relationships that we've had at Swiss Re for 10, 15 years, but are oftentimes in their funds 6, 7, 8, etc. And we want to add to that stable base a certain potential for outperformance that we typically see either in specialized strategies or on the smaller segment for various reasons. When I say potential for high performance, that also implies the potential for higher risk, in my view. So that is the factor that prevents us from just doing the entire portfolio in that space that some people regard as the most attractive segment. Now, the second point I mentioned, refreshing the gene pool. In our experience, and we've had over the last 10, 15 years, over 300 funds in our portfolio, we've seen that some of our most successful funds in previous returns were actually new creations of firms, Fund 1, with oftentimes experienced teams, which have reached 3x plus fund returns. And our goal is to find, and that was oftentimes 10, 12 years ago, our aim is to find the new generation of those guys as, you know, the priorly star performers have grown to a multi-billion size and naturally converge to a more moderate return.
Excellent. And that's helpful. I know at our firm, we were founded 25 years ago, and most of what we do is look for those emerging managers as they're emerging in the market before they've officially become a brand name. And those would be teams that have track records, have worked together for a number of years in the industry, and really helping them to raise those first, most difficult funds and then working with them on subsequent funds. But the question comes sort of naturally, and that is that there is a dynamic between the fund sizes that we've talked about, where you all as larger institutions need to put out a certain amount of capital effectively and manage the time that you're spending on diligence. And what would the thresholds be for you all? Maybe you could each take a moment to comment on what types of funds you can and would be able to look at, both fund size and some of the criteria that we've discussed.
Sure. I'd say for us, we're looking to commit 20 to 60 million as a range, so that gives us flexibility to pursue smaller funds, as well as be meaningful investors in some of the larger funds as well. And we can supplement that with co-investment capital during the life of the fund as well. We try to avoid having specific buckets that you must fill, and rather just let's find the best opportunity, regardless of whether that's a first-time fund or a more proven fund. We can do both, and we just like to open it up and let the best manager win at the end of the day. It is important for us, though, that when we're looking at a specific fund, we want to know what's the competitive set out there and make sure that we're picking the best one or two in that segment, because we simply cannot do every single fund, and we would not want to.
And that's a good point too. And you brought up the co-invest opportunity, and that's a great way for either teams that are spinning out or newer teams to get to know you through doing some work together.
Right.
Great.
Yeah, I think I can echo what Brian says. We have a very bottom-up approach as well. We tend to start with the manager, not with the sector or the kind of the macro view. So we try to find good managers, and that, you know, it could be within a given sector, within a given geography, and so on. And in terms of size, we're looking to commit, I would say, between 40 and 65 million. So pretty narrow range, as we would like each fund to have a meaningful impact. We don't want any fund to have a very large impact as well. So we try to kind of keep it around the 40 to 65 range.
Great. And Andrew?
Sure. Yeah, our bite sizes in general have been, about 20 million on the low end. It has gone into the hundreds on the high end, but for a smaller mid market, I'd say that the typical bite size has been, let's just say between 20 and 50-ish million. And what we try to do is, look for people that can work together, that have the right mix of skills, that are able, and to be able to understand what it is that they do well, why it is they do well, what it is about their firm's DNA, what's their backgrounds, their relationships they bring to the table, their past experiences, the operating skills, or what have you, they bring to the table that enable, the firm to either generate good returns or sustainable returns. Because at the end of the day, it's all about the people. If you back good people, they'll make things work one way or another.
Yeah, very similar case for Swiss Re. Our bite size range, I would say, is 20 to 50. Typically, we wouldn't go lower than 10, but would be willing to do less than 20 in a very early fund. That said, we try to keep equal bite sizes to echo what Christian said, to make sure that each investment has an impact in the end. That actually leads to potential more concentrated impact of smaller funds that have only, let's say, 6, 8, 10 investments versus larger ones, which oftentimes come with 30 investments. Now, you also asked the very good question: what's sort of a typical and acceptable fund size for those early funds or smaller funds? I think, in my view, it really depends on the strategy, and that's not any different from established funds. We go, when we look at a fund, from what's the EBITDA range that firm has typically been successful with or a certain deal strategy, and what's the appropriate fund size to replicate that going forward? So a first-time fund with a very experienced team may start at 500 to 800 million in the for the first fund size, which is completely okay if that mirrors the strategy. Whereas for they could have a very established lower mid-market growth fund that has been doing the same thing for 15 years and suddenly want to go from 200 to 400, and you would have to say, I don't see why you need that much more capital suddenly.
Good point. Holly?
So, probably similar to the others, I was typically looking to put in, to commit at least 20 million to a fund, and that pretty much let us do funds of around 150 million, as small as 150 million. Now, when you get to that fund size, that usually means it's a first-time fund or close to a first-time fund. So as a sort of a segue into first-time funds, I think most of us on the panel were interested in looking at those. From my perspective, what I typically looked for was obviously some sort of track record, the group having hopefully more than one key person who'd invested together. And as far as a track record goes, typically, maybe not 100%, but typically looking for an investment track record managing others' capital, not just their own capital, so acting as a fiduciary. These were also always important considerations, as well as having, on our part, some direct connection to the group. So, for example, perhaps they had spun out of a GP that we had worked with and we knew the people personally, or if not, having them be able to be recommended to us, not just referred, but recommended and known well by others that we had worked closely with and respected.
And that's a very good point as well, where each of you has very established programs with existing managers, many of whom are being held to the same level of scrutiny as a first-time fund, where you're going back and looking at their performance and making sure that they're someone that you want to back the next time around. For groups that are spinning out of larger organizations that have that track record, what other types of criteria would you be looking for? How many years of working together? How many transactions? And what type of multiple or IRR? I know we talked about that a little bit. What type of ranges are you looking for from those newer teams?
Yeah, I'd say for us, again, no set criteria in terms of length of track record or number of exits. We're focused on what is the firm done in the past? What have the people done as they're coming together? What is going to differentiate them in what we consider to be a very competitive market? And going forward, just what is going to separate them and allow them to do good things? So that could be specific expertise in sectors, very strong networks, or just other attributes that they can demonstrate to us that we can get some kind of proof and conviction around to convince ourselves that can work going forward. So that's really what we're focused on there. We've done first-time funds in the past. I think going in, we consider them to be more risky than a more proven manager. But again, it's let us do the work and get our hands dirty a little bit and really form conviction around the group's capabilities.
Great.
Yeah, and I think in terms of first-time funds, we would like to see at least a core group of people having worked together for some time and kind of established a track record within another firm as a group, or perhaps in some form of pre-fund setup. I think that's one of the key point for us. And then if they're spinning out of another group, then we would typically do a lot of work on attribution, understanding the team dynamics in the you can say the former firm, and then also among the spin out group. I think that's two of the key things.
Andrew?
Yeah, I guess all those criteria that that's been mentioned are important. But at the end of the day, what we do need is to have enough information and enough a record to understand how it is that the performance has been achieved, why it's repeatable, that it will work in the environment today, and finally that the interests with the GP are aligned with ours. So, and one of the things that I tend to focus a lot more is, the stuff that happens behind the closed doors, what I call the key decision-making attribution, who really made the key decisions there, as opposed to the person who's been out there running the deals, who are the people that, identified the levers and the opportunities for value creation. Those are the key things that I tend to focus a lot more on.
Yeah, I would echo most of what Andrew just said, and maybe only add that we also would need to see a few, 2 or 3 of the partners having worked together for a number of years, need to see a track record together to some degree. There's no fixed number of deals. And also very important to look into attribution in great detail, who did exactly what, were the partners really just running the deals, or were they also involved in decision making? Did the group they spun out of, did the senior partners there actually decline deals they worked on or not? That said, even if the group has a great individual track record, had, let's say, a first fund that yielded 3x, that still isn't necessarily enough. It would be easy if we could just check the box and then sign a check. Because we have had enough, every one of us has seen enough examples where you had a great 3x fund and the next fund was suddenly just underwater barely. So that's what I referred to initially as the additional risk we see or would incur consciously of backing either a first-time fund or a very small fund.
I'll just add a couple criteria, and these are not specific to first-time funds, but we would look even more carefully at first-time funds regarding these criteria. So one is a sourcing capability. It's critical. With an established group, they already have their sourcing mechanism. So with a very young group, you really have to explore it very carefully. And does a group have some sort of unusual grasp out in the marketplace? For example, do they have some sort of affiliations with some strategic players that kind of always show them internal opportunities if the strategic is spinning things out? Do they have a well-established outbound calling system that brings them sort of unique deal flow? So we go through the pipelines very carefully. Another thing, again, we look for from all GPs, but particularly with ones we don't know so well, is what is their personality dynamic vis-a-vis company managements. So, and particularly in growth equity, where they may or may not have control, that's really very critical. So, can they let management teams run with the ball when those teams are very strong, and are they able to step in when teams need some assistance in a timely manner?
And Edward, you sort of led the discussion of talking about how you personally and within your firm sort of step outside of the box and try to find ways to find the teams that are thinking about spinning out and finding them early, because a lot of times these tend to be naturally smaller funds where if the partners have that very strong track record, it's going to be in fairly high demand, and some of the ways that you find the best opportunities.
Yeah, I think that gets to the core, I think, of what we all want to achieve is find those few exciting opportunities. I think one obvious point is for us and all of us who have a large existing portfolio of hundreds of funds, to if somebody spins out of one of those established groups, to be amongst the 10, 15 people who get the first call and get notified. A second point I would call just basic networking, and just happened to run into somebody earlier today at a conference who I knew from many years back and said, "Oh, I have a new fund in growth equity." And I think a third one, also important, especially since there's always a trade-off between LP organizations in terms of resources and people available. I think you need focus in terms of what do you want to spend time on, and where can you quickly say that's, we probably shouldn't, in mutual interest, not go down taking 5 or 10 meetings.
Great.
I would just add one thing to that, and that is that there are a lot of fundless sponsors now, and they even have obviously sort of conferences and networking events for those groups, and I think many of them, maybe not all of them, but many of them want to and will eventually become fund sponsors. So that's also a good avenue for looking.
Great. We've had some great suggestions. I think everything from Brian's comment about having that competitive advantage, maybe a barrier to entry that other folks are unable to reach that segment of the market. Is it a repeatable model, I think is something else that we heard, something that will be tried and true from fund to fund. Decision making and deal attribution, I think Andrew and Edward talked about the importance of being able to have a very tight attribution, one that can be vetted by your limited partners easily if there's a question in there that is uncertain. I think to the point of who actually worked on the deal, who had the decision making, was it balanced? And then the concept of the partners working together and how does that dynamic fit? Is it complementary? Are the styles lasting? Any other suggestions that you can think of? So those are all great points. Would love to answer a few questions before the end of the panel. Anyone has anything that we didn't cover? Yes. So the question is, what would the percentage of the fund, and we talked about this on fund size and sort of the dynamic, what would the size of the fund need to be, and what would the percentage be in general for participation?
So in terms of our percentage of the fund, on the smaller fund sizes, we could take up to, I would say, 15 to 20% of the fund.
I think in general that was the comment that maybe around 200 million is sort of the threshold for some of the larger institutions where they need to do 10 or 20% of the fund. It's a great question. Anyone else? Okay, I'd like to thank our panelists and thank you all for joining us.